All right. So, okay, recording now. So, but yeah, so we had talked a bit, like I said right before this, about the Warren Buffett case and everything. But just as I guess, an opening question, who's Warren Buffett, and what do you know about Berkshire Hathaway?
He's an investor from Omaha, Nebraska. That's kind of close to home for me. I'm from Iowa originally. He's done very well for himself. He's a long-term investor too. So he's going to think about stuff in the long term. And, it seemed like Berkshire Hathaway, they have it's very diversified investments, what they have. And I don't think they were involved in this type of investment prior to, Warren Buffett's investment. But basically, Berkshire Hathaway was an older company. Was it cotton and textiles?
Sorry, I was muted there. Sure, exactly how it began. Most of their assets, and you may have seen this when you were looking at the case. Actually, let me. Here it is. Okay, hang on. I'm going to share my screen. It's that file I just shared. Well, maybe I don't have it.
Yeah, it was a textile company. I just thought.
Okay. Okay, I was going to say, because I know a lot of their assets now, are held in insurance, right?
Oh yeah.
That seems to be the biggest chunk. So I didn't know if maybe it had started, long ago in like a farmer's, I don't know, insurance and trust or something like that.
And I'll tell you this. There's a lot of good tier one companies that they're invested in, like John Deere and Procter & Gamble and different companies like that. That's I consider tier one companies.
Well, they own Geico outright also, right? So they own Geico, they own Genry, General Reinsurance. So yeah, so that's so as you were saying, Berkshire Hathaway, we refer to that as a conglomerate, right? When it owns a lot of several unconnected industries, right? And the idea with that is he's building diversification within the company in a way. Does that make sense? Like he wants a wide, he wants options, right? That's what he's trying to build. He's building a real option solution set. So if interest rates go down, he can do this. And if interest rates go up, well, he can move over in this way, right? And if trade policy starts interfering with imports, then he can go this. And then if we get more free trade, he can go that way, right? So by having all of these very diverse companies, it builds that in, right? For him to have a way to create value through that, right? And did you guys, they had his investment philosophy in there. So if you guys don't mind, I'm just going to kind of read one off, and then you tell me how you interpret this, right? Just somebody kind of jump in. But when he says focus on the economic reality and not accounting reality. So in your mind, what does that mean?
I mean, economics is like the study of how individuals interact with the market. So think about personal interests, what society's trending towards, and not actually like physical numbers.
That's good. Anybody else have a different take on that?
Yeah, sure. So under GAAP accounting principles, they don't take into account things like patents and trademarks and special managerial expertise and reputation. Those aren't considered in a company's figures, so that has value.
Good. What else? Anybody else have anything else that's like maybe where accounting doesn't tell us quite the truth?
the quality of their management also.
Right. Well, what I was thinking of too was just that book value versus market value, right? Whenever we're talking about financial statements, it's, well, we bought it at this price and it's been depreciating for this long, and that kind of thing. So it's very true. Cam, you were saying, hey, we got to think about, individuals are making decisions, and this is how these things will work. And yeah, there's definitely a lot of stuff that is accounted for under GAAP, right? I'm not saying like people are doing things wrong. This is the system we agreed to, right? But we have to understand those accounting numbers are valid. I'm not saying that they're not, but they mean something very specific, right? And when we're making a decision, we may need a different type of number, right? And so that's just one of the big things that we need to keep in mind. Now, this is where we go back to the economics bit. So Cam, you had kind of jumped in on that. So accounting for the cost of lost opportunity, right? That's another one of those sort of economic things. We have to think of the opportunity cost, right? It's not just how much does it cost us, how much do we have to pay? So this is an acquisition for Berkshire Hathaway. They have the money, right? They can go make this acquisition, but if they're not buying them, then they could take that money and instead go buy a French soccer team, right? Or something like that, right? A completely different type of company, right? So there's the potential to make money somewhere else. If nothing else, they could have just bought treasuries, right? Just stuck it with the federal government and collected some interest. And that would have been so much less risk, right? Than going out here and buying this manufacturing firm. So that's another piece on that. And we talked about this a little bit before class started. I put up a video about the time value of money. But anybody here that's already seen time value of money, I'm not expecting you to have watched my video yet, but it's out there, it's in our playlist. But can anybody here sort of say what the time value of money is and what that means when we say that?
It's basically how much you expect your money to grow into based on how long you have it invested and your return that you're receiving.
Right. This is what we think about whenever you hear somebody say, "Oh, it's this much in today's dollars," right? That's always going to be a hint that we're doing something with the time value of money, because I would much rather have $100 today than $100 in 2030. Right? I have no idea what America is going to be like in 2030, but I know $100 is probably going to have less purchasing power than it does right now, right? So I could say that I would want my money today, right, as quickly as possible, right? And so that's part of his investment philosophy, Warren Buffett, right? Is he's saying, look, sometimes you got to think about, when are we getting our money back, right? Is this something that's a long payoff, right? Where maybe we pay money into this thing for 5 or 10 years and then there's a payoff, or is this the kind of thing where we start getting money back within year 3, right? Because it's not just the amount of the cash flows, but it's the timing of it as well, right? And just to touch on this as well, another thing that he had specifically mentioned was the focus on wealth creation, right? So he views that as taking on those positive NPV projects, and we're gonna talk about that type of planning later on in finance. But what that's saying is, what we're looking to do is build anything that's going to allow the company to continue its sustainable growth, right? That's what he is trying to do, right? He's buying companies with a strong brand. It's in a stable market, that kind of thing. So who was it that was speaking earlier? I think I missed your name. That's from Iowa.
Oh yeah, that's me, Dr.
Derek.
Yeah.
Okay, I'm sorry. I can't see everybody's at the
I
same
understand
time.
that.
So I got too many people on the screen. But but like you were saying, he's sort of like that patient money, right? Like he's okay with waiting. Now he's going to use a time value of money calculation, but he's definitely willing to wait, as opposed to like someone that's a hedge fund, right? Hedge funds are trying to get a higher return, and they're trying to get it quickly so that they can reinvest that money, right? They're trying to keep everything working for them, right? So that's like the stuff that he was saying, hey, I agree with, all these things that we teach in business school. One of the things that he disagreed with was about diversifying a portfolio, right? So he doesn't want to own things that he doesn't know, right? So what he does is he builds his diversification within his company, right? So he's got this large conglomerate. It looks like it's a diversified portfolio on its own, right? He's got insurance companies and let's see, I'm trying to think what all, because I think they gave a list.
He's got railroad companies too.
Railroad company, yeah. It was like I think they gave us a list like the top 10.
Even a pharmaceutical company.
The top 5 transportations.
Right. And then he's got that Scottish utility company. So he's got a wide assortment, right, of investment. So he's like, look, I don't want to go out and buy a bunch of random stocks just so that I'm diversified. Instead, I want to build the diversification within a system that I have better control, right? So I don't know how applicable that is to the general investor, but that's just one of the ways that he disagrees, right? He's also I'm trying to think how to put this. So he thinks that markets aren't completely efficient, right? So when we talk about market efficiency, the two things that we're going to talk about is like operational efficiency, is like how quickly they can process an order, right? And that's one thing that they're constantly trying to refine, right? Hedge fund, investment banks, these companies are constantly trying to find like a faster processor, right, to process order just a little bit faster than that other broker, and they just get a little, just to get a little bit ahead of them. So that's one type. The other thing is what we call pricing efficiency. And this is how effectively the market can take information and then move that into the price, right? And so if markets are completely efficient, then the price is going to reflect all of this information, right? And so, if you don't have any sort of inside information, you shouldn't be able to beat the market in that case, right? Because the price would reflect the information, right? And so, he's like, look, clearly they're not efficient because my company wouldn't make this kind of money, right? If markets were already being efficient. Markets are not efficient because they're too short-sighted, they're too undisciplined. There's too much information for people to understand, because it's from so many sources. We normally think of markets as being somewhat efficient, but in this particular case, he actually disagrees, and he's like, no, I wouldn't get the returns I get if that were the case, right? And so let's just go from there to talk about this case where Berkshire Hathaway wants to acquire that PCP company, right? And I think we have, let's see. So I'm just looking over the let's see. Right. So what happened to Berkshire Hathaway stock when it was purchased, right? I'm trying to see where it was in the case, because I think that then to say that they dropped like $4 billion when they announced that. I see some people are nodding, so some of you remember seeing that, right? So does that sound like the market thought he made a bad choice, I guess would be my question. How do you interpret that?
That's just the initial reaction. You can't just make your determinations off of that. You got to see what happens, a year or two from now. And I think that's the great thing about, his investment strategies.
Oh, sure. I agree. We would want to look, but when you start that initial reaction, why is it falling $4 billion? At least in the short term, right? It sounds like the market's like, you're overpaying, right? The offer that you made is greater than the value it's going to return, right? And so the only way the market can say, we think you're wrong, right? Whether or not we can talk about how it paid off, a few years down, but markets, this is the argument I was just making, right? Where he's like, they're too short-term focused, they're too reactionary, that kind of thing. But Warren Buffett is saying, look, this company is going to have future cash flows, right? And what is the present value of those future cash flows, right? And so we were given, the revenue, right, the EBIT. So we can think of, from multiples of that, what would the market value of this be, right? Let's see. So if you look on the case, like Exhibit 10, right? This is financial data for comparable firms, right? We're trying to find some way of figuring out, how does this compare within their industry, right? And these are other precision, tool companies. So, and then if you look at Exhibit 11, right? What this is doing is saying, hey, okay, so if we assume, that this is their comparable industry, right? We could take a firm, right? And you see where Precision Cast Parts is. Look on Exhibit 11, right? It lists, Alcoa, Lissy, ThyssenKrupp, Allegheny Technologies, Carpenter Technology. It lists all those. It calculates a median and mean. Does everybody remember what is a median and what is a mean? You may want to say that real quick.
Mean is the average. Median is what's in the middle.
Right, and what's in the middle, we could also say the 50th percentile if we had a lot of things, right? And so in this case, it's going to be, that third value since we have 5 companies, right? So, but yeah, so we can see what the median and the mean is for the market value of the equity, enterprise value, book value. You see how those are listed there. And then the enterprise values being a multiple of either revenue, EBITDA, and EBIT. So what this is for is just a way for us to say, okay, if we assume that this, again, this is the market that we're looking at, how much should Precision Cast Parts be if it were like the median firm? Or what would it be if it were the mean firm? Right? It's kind of like 2 ways of thinking about an average, right? But what would the value of it be, right? And then that right there is what we could use, to make a bid, right? So if you look at the mean value, implied value mean for EBIT, right? Enterprise value as of EBIT. Okay. This is in that's in millions of dollars, right? So for instance, the implied value based on the median multiple of EBIT is 37,755 million, so $37 billion, right? And so if we look at the mean, 37.7 billion, that's really close to the 37.2 billion he bid for it, right? So it looks like maybe that's what Warren Buffett was doing, was he was saying, okay, well, I'm just looking at earnings, let's just take that number, right? The reason you would take earnings before interest and taxes is because interest, that's just going to be a thing of the market, right? Whether or not we're taking out loans, issuing debt. Berkshire Hathaway is probably going to, change their capital structure after they acquire them. And so, that'd be a good reason to look at that, piece, right? But if he's like, look, based on what their EBIT is, then I would expect it to be worth 37.7 billion. He bids 37.2 billion, bakes in 500 million, of value for himself. Then it looks like it's a pretty good bid. But as you can see, you get numbers that are kind of all over the place, right? Depending on what numbers you're using, right? If you were to use the median instead of the mean, there's a $10 billion difference in that valuation, right? And so having the market react negatively for about $4 billion doesn't sound necessarily unreasonable, because people could have done this type of valuation calculation and come up with something different. Maybe they thought, oh, this firm is actually worth closer to 33 billion, right? That's what you should be bidding on it. All right. Does that make sense?
Yeah, that makes sense. I'm curious. I don't know. Why didn't he bid or closer to the median value then?
I'm going to guess that he probably does something that's a bit more sophisticated than this, right? Yeah. So he probably had something that, a bunch of different approaches, and they all sort of converge in a general area. And that's probably how they came up with that, right? So I think that's that's a lot of it. Plus another thing that you got to remember that could happen. I don't know if you guys saw like a week ago, I was on the news because we were talking about the stimulus, but when we were talking about that, I mentioned, none of this got on TV because apparently it's boring for the news, but I was explaining like, okay, this is, $2 trillion that are going out. And so if you look at interest rates, right, the treasuries are still low, but you're getting separation between what we call TIPS, which is the inflation protected treasuries, and then just treasury like T-bills. So you're seeing this separation, right, between the treasuries and the TIPS, which normally implies that we're going to have a lot more inflation, right? But when you looked at the stock market, there was a huge rally, right? So stock prices went up because it's like, hey, there's $2 trillion extra dollars, right? But tech firms fell, right? And it wasn't because there was any bad news about tech firms or anything like that. It's just they don't pay anything, right? And so the value of a tech firm tends to be, well, the stock is going to go to the moon, right? And I'm just going to ride the stock value up, right? Well, if I have to include inflation, suddenly I'm discounting it at a much higher rate. This gets back into that time value money piece, right? And so through no fault of their own, these tech companies were seeing their values decline while everybody else increased. And it was because of inflation, right? And so where I was going with that is, you have to remember too, that things shift quickly, right? And so it could seem like it's really good. And by the time you go forward and you've made the deal and the stockholders get a chance to vote and all those things, things may have moved a little bit. Now, in this particular case, there's really nothing that would imply, that it's going to, well, let's just talk about it a little bit more, right? And then we'll talk about how it kind of how it went, right? So they lost a little over $4 billion, right? And so you would say, well, okay, why is that? So it could be maybe Warren Buffett lost his self-discipline, right? He's famous for, being such a principled investor, right? But Berkshire Hathaway was holding so much cash, right? Maybe they felt they needed to put it somewhere, right? So that's a possibility. The reason we would think that, and again, I'm not trying to say this is what Warren Buffett did, right? But the reason we would think that is generally when corporate acquisitions are really big, it destroys value, right? We think there's all this value that's going to be there, but you end up inheriting this extra bureaucracy. And it takes so long to sort of get these companies working together because they are so big that it ends up often, destroying value. They were better off just being two different companies, right? Than becoming this conglomerate. So I'm not saying that's what is happening here, but that's a reason that we would think that, right? It could also be just like I think Derek was maybe alluding to this, just like maybe the markets are just pessimistic, right? The estimates are just too pessimistic, right? It's one of those things that there could be something that he just sort of knows, right? I'm pretty sure that this is going to work. Like that's why he normally gets outsized returns, is because he kind of knows something is going on. Not that he's trading inside information. I'm not trying to say he's doing something illegal, but he just may notice, little things, right? You've been around people that are like that. They sort of pick up on small details. So, and so that's one of those things too. So it could be that by digging through the financial data, maybe he found some like larger cash flows than were expected, right? He might have been like, hey, I really see where there's a lot of value here. But they're just being real inefficient, right? And so one of the things to sort of think about as we're thinking about whether or not we would want to do like an acquisition or anything like that, the first thing is, and this, take this with a grain of salt, I guess, because I'm telling you this stuff, right? But number one, cash flow. Right, because that's what you really care about if you're looking at a company, right? Do they have cash flow? Because if they just give credit to everybody, they can have lots of sales, but that doesn't mean they're ever going to collect that money, right? And so you always want to look at the cash flow. What is actually coming into the building and what is leaving the building, right? And that kind of gets to that separation a bit about accounting truth and economic truth, right? But that's one of those things that I would say look at. And then the next thing would be when you're thinking about the firm, right? The price of the firm is not the value of the firm, right? Unless the market is always efficient, right? And so if investors can get spooked and cause things to shoot up and shoot down, then we know that the company didn't change. It was just the stock price started doing weird things, right? If you think recently to GameStop, right, and what has been going on with GameStop's stock price, GameStop hasn't changed at all, right? They're still buying your used games for $2 and selling them back to you for $20, right? That's their business model, right? So we know none of that is changing, but their stock price has. So price is not the same as value, right? And even in this case, once we saw, the market react. Well, the price doesn't reflect value, right? Another thing is every investor is going to value things differently, right? If you look at that, all these different multiples that we were looking at, we were seeing these wide ranges of value for this precision manufacturing firm, right? And so just understand everyone is going to value things a bit differently, right? And so I think that in this particular case, it did it did raise a lot of eyebrows, right? So if it is going to be as successful in the long run, because this was in 2015, this acquisition. So, we've had some time. I don't know how precision manufacturing has gone. I don't know what the future of that really is. Just in general, I just don't know enough about that industry to comment. But he actually said in an interview that it was like a fat wallet is the enemy of investment results or something like that, right? So if you have a lot of cash, the cash doesn't make you any money, right? And you get really tempted just to put it in something, right? And I'm not saying that's exactly what he did, but the firm has 67 billion in cash or cash equivalents, so he's always kept cash available because he likes to have the flexibility. If some option comes available, he likes having that possibility. But that was like too much cash you could think of. And so whenever we're going to go through cases like this, this is the kind of stuff that we're going to talk about. So we're going to do a couple of cases each week. We'll do a case like this. I'm going to introduce new materials in those videos between classes for you guys to watch, and then in class we'll focus on doing the case discussion like this, right? And so this one was pretty straightforward. There was a lot more really more discussion around who's this Warren Buffett guy, and why do we care? He's a successful investor, and this mindset of, hey, let's go in, let's look at the financial data that's available to us, the 10Ks and the 10Qs, and we'll go look at this. I think you guys have seen now that financial analysis video, where I talk about ratios and all that kind of stuff. So we're going to do that. We're going to do the DuPont formula. And so that's going to be looking at how do we get a return on equity for a firm, right? And you can think about how efficient is the firm at taking assets and generating sales, right? And then how efficient is the firm at taking sales revenue and turning that into net income, right? And then we'll have like an equity multiplier piece at the end. So early on, that's how we're going to be doing these cases. And then we're going to, there's that time value of money video for you guys to watch. So we're going to talk about that and changing discount rates and stuff like that going forward as well. So we'll probably do 2 more cases where I kind of walk through it like this. And then since there's 4 groups, then we'll have 4 weeks where each group will do like a PowerPoint presentation and walk through the case. Does that make sense to everyone? All right. So do you guys have any questions about sort of how that case was or anything like that? Easy peasy stuff, right? It's just finance, right? So I'll put up some more videos. So I'll just keep putting, everybody can get to that playlist, right? I haven't messed up and made my YouTube locked up or anything, right? Try to make sure I don't have music in the background or anything, because those YouTube algorithms will get you. But yeah, so I'll keep adding sort of like our lecture type videos, because I know you guys do not want me to come in here and for 3 hours, talk about PowerPoint slides. So I'm trying to break these things up into smaller pieces and then put those videos online. You can watch it, 2 a.m. on a Saturday morning when you can't sleep or whatever. My voice will help you. But we'll keep putting those videos up, and then I really wanted to use this time to go over these kind of cases and talk about stuff like this. I think it's a better use of your time if we can, break the boring lecture type stuff out, and then we can talk more about real real world stuff. So, and I'm sorry, I know Miss Jacobson is catching us from the road. She's on a bus right now, and then we got a bunch of guys that are traveling for a game. So unfortunately, we don't have the full crew here with us today, but hopefully we will next week. So, do you guys have anything for me? Anything we should talk about?
I was going to add about the precision cast parts, a recent update. I was just looking it up.
Yeah.
As of February, it's now being called like a $10 million mistake just because of the pandemic.
Right. Yeah. I mean, that's part of the thing. We start looking at, acquisitions in 2017 and 2018. It's like, yeah, it looked really good back then. We had no idea, what was a few years down the line. Right. So, I don't know how many people had just started restaurants, right? That seems to be an industry that always has people struggling, but I don't know. We found a way to respond. I think letting people deliver margaritas saved a lot of restaurants, because they were at least able to get liquor sales in there, since they weren't able to, fill the restaurants anymore or whatever. So I guess we'll always find a way, but yeah, well, thanks for looking that up. I mean, that's one of those things though. I mean, how would he have known? Right. So I don't know if I told you guys when COVID hit, and then we locked up the airports and all that stuff. It was over EKU spring break. I actually had a class in Bermuda. I was worried I was going to be stuck there. And you may think, well, there's worse places to be stuck, but you just don't know how expensive those islands can be if that's the case. Because I didn't think I was going to be able to stay, and I knew the students we were going to be panhandling out the airport if if we were going to be there too long, because it was rough. But yeah, all right. Well, it takes a little bit for these. Okay. Somebody's asking, hey, how do we know when each group presents? I tell you what, how about next week, when everybody, hopefully we get all the guys back, that we can just say which group wants to do which week. And actually what we could probably do is I can, at that point too, go ahead and do the cases, and you got, because that way you'll have a company name or something, and you can say, oh, hey, that sounds cool. I want to do, Kmart or whatever, so I'll have some cases, and you guys can kind of pick which one you want. I tell you what it's about, and everything, but that way you can pick the case that you want to do, and I'll give you a few options. But what I'm wanting to do, like I said, this is just like some little introduction. Hey, this is how to think about cases and stuff like that. But as we go through, it's going to be, okay, here's how to calculate cost of capital, or here's how to talk about dividend policy, or here's how to talk about, inventory turnover, leasing versus owning, those types of problems. I think we actually even have IPOs. If you guys are interested, we can do that. I can be really flexible, right? Because I'm going to do all your lecture stuff ahead of time, and just post those as videos, which gives us a lot more flexibility in our cases, that we could do stuff that sounds more fun to you, right? Since we're going to focus on that, with our class time. So I hope that answered your question. We'll just do that when we all get together, right? So I just want to make sure we have all the groups here, when we pick all that stuff. So next week they should all be back, and we should be good to go. So do you guys have anything else for me? Okay. Well, we'd already discussed, we're not going to do one big 3-hour session. So since I record the lectures ahead of time, so we don't have to stay late. I'm going to let you guys go. It takes a minute for this video to render, and then it takes a little bit longer for YouTube to upload it. And then something about my uploads or whatever, they hold it for a minute, doing all the whatever checks and all that stuff. I never load anything too interesting, and I always have 40 views on a video, so it's not like I'm I'm doing like PewDiePie viewership or something. I think, you know, but I think they watch me harder than they do the big people. But yeah, so but I'll get this video up as soon as possible, and as soon as I do, you guys will be able to review it, and then I'm going to go ahead and put up a few more, like I said, lecture videos, but do go back and watch the one I put up earlier on the time value of money, because in there I show you the equations and everything, but I also show you how to do it on the calculator, and I show you how to do it in Excel. And that's really what I want you guys to kind of take away whenever we're doing stuff in here. I'm going to, as much as possible, show you how to do stuff in Excel, right? Because I want you to be able to do it at work, right? And I know you're going to probably be sitting at work with a computer and you'll have Excel, right? So even if you're not really sure exactly all the formulas and all that, nobody cares, right? As long as you can do it, do the math, you know, with Excel or whatever, you'll be fine, right? So you never have to memorize formulas for me, right? I mean, like some of these ratios, I think you should probably learn, but we're not very creative in finance, so we just name it exactly what it is, right? Inventory turnover, right? So that part probably won't be as challenging, but memorizing formulas, I mean, there's no reason for a grad student to try to memorize a formula sheet. So I'm going to try to focus on learning how to do everything with Excel in this class. So, but I do like the BA2 plus calculator. So I'm also going to tell you how to do it on that calculator. For those of you that, I don't know how you're working now, and I know some of you guys are not working, you're just doing full-time student stuff and everything else, but the BA2 plus you can use for like the CPA exam, the CMA exam, if you want to be a CFA, the financial analyst, all those exams, they don't allow programmable calculators, but they do allow financial calculators that have all those equations baked in, right? So that's why I always like to teach that as well. I'm not going to make you do it, but if you wanted to learn that, I've got slides where I show like how to do it on the calculator and everything. So that's the calculator I learned how to use years and years ago when I first started doing it. It's literally the same calculator. I mean, it's highway robbery that they still charge like $30 for the calculator, since I know whatever technology went into that paid for itself back in like 1974. So, you know, they've just, Texas Instruments is just making hand over fist with these calculators with what they charge and how old they are, right? The technology. But anyway, that BA2 plus though is really useful if you're going to go into a profession that's going to have those types of exams, right? It's just a real easy way to do those types of calculations. So, but again, like I said, I'm much more focused on you guys learning how to do it in Excel, right? Because that's the one that we're going to really need to focus on. So, all right, well, I'll let you guys go. I'll see you next week. We're just going to do this each Thursday evening. All right. But please just keep your eyes open. I'll make announcements. I've been trying to, whenever I put something, I'll try to make an announcement, but I'll make announcements to let you know as I'm adding more and more videos in. I want to look through a couple of other YouTube channels, kind of like how I did that one about the real estate agent. Did you guys like that video, by the way? I think that's so much more fun to watch a little 3-minute cartoon video explain it than have me ramble for 15 minutes, you know, kind of going through like principal agent problems. So I'm going to try to find more of those types of videos too, the slick professional, you know, ones like that. Yeah, so I'll probably put a couple of those types of videos in too, as I'm introducing more and more of these things, just so that you can maybe get a different perspective on it, you know, and make it more memorable for you. So just be on the lookout for that too. So you guys can go now. If anybody has anything they want to stay back and talk to me about, I'll stick around for a little bit, and otherwise just watch those videos and we'll go forward from there.
Dr. Wood, just a random question.
Yeah.
My group is getting together and we discussed the Warren Buffett case a little bit, and we sort of talked about even doing, is a SWOT analysis ever super helpful in these, like for us to understand the company?
Well, oftentimes we may not have enough in our case for a SWOT analysis, because normally what we're looking at is really just the financial analysis piece, right? So with SWOT, that's more like on the marketing side. So you need to understand a lot more about what is available, like what markets are out there for them to go into, right? And that type of thing. It wouldn't hurt with the information that you have, but it may not look the same as like what you would do in a marketing class, right?
Right. It might be incomplete.
Right. That would be the only thing. So as we go through the cases, let me actually, I think we've got the book right here.
Yeah, we more used it in this case just to kind of get an idea of, I don't know.
Oh yeah, it doesn't hurt. Yeah, it does not hurt at all. Please don't let me discourage you. I was just letting you know that, we don't, our cases are written more from, hey, here's the financial statements, right? Where a lot of times SWOT analysis, they give you a lot more information about what the market conditions are, right? And that kind of thing. This is their demographics, those issues. So it's not out of place. I don't want to say that. It's just our cases may be written where you don't have that information, right? Okay. Like with Berkshire Hathaway, you don't really know what all power companies they're involved with. So you're not really sure what the regulatory environment is and stuff like that. But, this is one of those companies, it's just a beast, right? I mean, this is like the old General Electric, right? It was like they made, refrigerators and they made nuclear missiles, right? I mean, it was just like they ran the gamut, and Berkshire Hathaway is kind of like that. They've got their fingers everywhere. And so a lot of times it's hard to do analysis on something like that, as opposed to say a Ben and Jerry, right? Where it's like they make ice cream, and that's their thing. Actually, I think they're owned by like Dryers now or something, or Unilever, one of the big food companies bought them up, right? But if you're doing something like that, it's easier to do that analysis.
Right. Yeah, our bullet points are pretty minimalist. I mean, we didn't have, not to go into it, we put like diversified portfolio under a strength. Right. I mean, yeah, we didn't go into a whole lot of detail.
Right, but you're exactly right in the way you were thinking of that, right? The fact that the firm itself is diversified, right, is obviously a strength that they have. Although I think you looked it up, diversifying this way was not seen as a positive, right? So it's generally he wins in those, but in this case, the market did not agree with him. So
okay, thank you.
But yeah, and in the future, cases tend to be a little more direct. Like this one was more of a, like I think if you looked at the scan, this was like case one in the book of 60 something cases. This was more of a, hey guys, let's just talk about cases, right? And everything to sort of work our way into it a little bit slower, right? So let me see. I haven't actually picked our next case exactly. I was thinking about doing a FedEx UPS comparison case, but there's also a case. It's not really a case, so it's probably one I should do first, with you guys. But what it does, it's called the Financial Detective. And so what we do is we just give you a bunch of firms. We don't tell you who they are, right, or anything like that, but we'll tell you the industry, right? And it's like, here's 2 newspapers, here's 2 hotels, here's 2 pharmaceutical companies, here's 2 power companies, right? And so you don't really, but we do like the financial analysis, right, that we were talking about. We do that, in each one of these industries. You can see how these industries are very different. Some are very capital intensive, some are very labor intensive, some carry a lot of leverage, right? They have a lot of debt on the books. Other ones, they don't carry much debt. Airlines, there's a big difference between a Delta and a Southwest, that kind of thing. So that's probably the case we're going to do next.
I vote for that one. How about you, Tim?
I'm open to whatever.
Okay.
I like it.
Well, I think that's what I'll put up next then, is that, like I said, the financial detective.
So that one we will be doing some calculations.
Yeah, that one is doing calculations, and that way you get to let me see here.
So I love the practice and fill them out. That's why I wanted the other Excel spreadsheet, just to kind of start fiddling with some of the formulas that we have.
Right. Well, this is, let me share my screen. I'll show you.
I actually went through today and created an Excel spreadsheet with all the different ratios that were in that PowerPoint. So
okay.
It was a little time consuming, but I built it, and so that's a plus.
Right. And you obviously understand them a lot more, right? Because you've gone.
Yeah, that's my main reason for doing it, to have them, obviously, but it helps me to learn it as well.
Well, you did one
right
too. I remember you showing me that, Tim.
But yeah, so there's obviously a whole case write-up, but I just wanted to go ahead and show you. So like we'll give you a bunch of numbers. It's like we won't tell you who the airlines are, right? But then it's like, when we do common size balance sheets, I don't know if you did that in accounting or not. It's where you try to, you basically, with your balance sheet, you're dividing everything by your assets, right? And you're saying what percentage of assets, and then the debt, is a percentage of those assets as well. And then with the income statement, you divide everything by the sales revenue. So you start with 100%, and then you're subtracting off different percentages, and then you end up with like 7% at the end, and you're like, okay, that's my profit margin, right? At 7%. I keep 7 cents of each dollar, right? So that's what these are set up as. And so you're seeing right here, this is what percentage, right? So this airline B has a lot more cash available, right, than airline A. But airline B is also holding a whole lot of property, plant, and equipment. They must own airplanes, and this one owns some airplanes, right? But
also interesting that A has a lot more value in like goodwill and intangibles too.
Right. So where do they get goodwill?
Yeah.
Do you know where goodwill comes from?
Oh gosh, we talked about it in accounting. I wouldn't be able to put it into words.
I'm going to tell you the mean finance way of what goodwill is. It's how much you overpaid for companies.
Yeah.
Right. That's what goodwill is. This is how much we overpaid for companies. So airline A must have like been buying companies in the past.
Yeah, I knew it had to do with like an acquisition.
Right. And so that's kind of what we do with this one. It's like we're going to go through these numbers and try to tell a story, right? And then we're going to see if we can kind of guess which airline is which, and which one of the, which beer company is C or D, like we'll go through it, and then I'll say, okay, here's the two airlines. Which one do you think is which, right? And we'll talk about it. And then, so it's as close to CSI as I can make finance.
On a random question, like looking under B where it only has like 1% in goodwill and intangibles, could that just mean also that it hasn't purchased a bunch of other companies, or just didn't overpay for them? Is that any indication of how many companies?
It's probably more that they've acquired a lot less.
Okay.
Now, one thing that's kind of weird is they could have acquired a whole lot, and either they've written down goodwill. I mean, that's possible. Or it could be they're just so much bigger, right? That even though they've done a lot of acquisitions, because they are so big, it still is a small percentage. But in this case, just looking at it, I would guess, oh no, this one firm has just done a lot more acquisitions. Maybe they're an older firm. They've had more time to buy up other airlines. Because you have to remember, airlines used to be a highly regulated industry. So we had a lot of competing airlines, but they weren't allowed to compete on price, right? And so you had all these airlines, and they had really nice lounges and the really nice first class seating, and all that kind of stuff. And once they were able to compete on price, it turns out people didn't want to pay for that. You know, they wanted cheap tickets. And so you had a lot of airlines that merged because they were like, we got to do something to keep this, you know, company going. And so there's a lot of airlines, like when I was a kid, Trans World Airlines, you know, it was a huge TWA, you know, they're gone, you know, that kind of thing.
It'd be interesting to compare things like, what is it? Frontier, and what's the other one? The ones that they charge for absolutely every Allegiant. They charge for absolutely every little extra. And if you actually add up, I mean, if you don't think about what you need to go on this trip, I mean, you'll end up paying more going with them.
Right. Because that's what they're trying to do, is literally sell you as little space as possible, right? Like that's, you know, they're trying to be that lowest cost provider, right?
For intangibles, does that include like patents and things like that as well?
It would. Yeah.
Although
this is an airline, so they probably don't have that, but yeah, patent it would be there because that's your intangible assets. So but yeah, so this is what we'll do next. And then here's like an income and expenses. Let's see if anything really jumps out here. Other operating expenses is a lot higher for airline B, and maybe something to read in the case a little bit and see what that's about. But yeah, so if you look at airline B, right, the cost of goods sold, the cost of delivering the flight, airline A only keeps 30 cents on the dollar and airline B keeps 40 cents, but they end up with all these other operating expenses that kind of eats a lot of that up, right? And so maybe this is like a structure thing of how the firm is structured. I don't know, we'll read the case and we'll talk about it. So I haven't read this case in a while, so
under market data,
but yeah, I'll put this on Blackboard.
Awesome. Under market data, maybe you can explain beta from, because it was listed as like the last sentence in this case, the beta of PCP.
Yeah. Okay. I'm sorry. Yeah. Beta is how risky the stock is relative to the market. Right. So a beta of 1 means you're the same like riskiness as the market. Right. The way we actually calculate it is with the covariance of the stock and the market. Right. And so, so a beta less than 1 is generally seen as being safer. A beta greater than 1 is seen as more risky.
So then the 0.38 that PCP became after the acquisitions, the acquisition really helped them as far as they were seen as less volatile, or?
That's exactly what it was. Yeah, they were just seen as maybe they're not going to make you a lot of money, but it's going to be very consistent, whatever it is, right? And if you think about it, they don't make tools for me, right? That's not what they don't make, like screwdrivers to give me. They make tools for like a tool and die, you know, like they make big tools, right? You know, that kind of thing. So this is a firm that's dealing with industrial customers, not retail customers, right? And industrial firms, it's going to be, hey, we're going to agree to this type of contract and this, you know, so that's why it tends to be very stable, right? Because it's just these long-term types of agreements, right? So they're making the tools for like Toyota up the road, you know, and that kind of thing. So
I think I mentioned Rolls Royce or something in there. Yeah.
Right. Yeah. So a lot of people don't realize how many precision specialty tools are out there, right? But there's not a lot of companies that make them, but those that do, they pay a lot of money for really smart engineers. I've got some buddies that do that kind of stuff, and they design like drill bits, but for oil rigs, yeah, you know, and stuff. But I'm like, how much more technology is there? You're digging a hole, you know, but they find a way, right? But yeah, so that's what beta is. It's that measure of riskiness relative to the market. So, and it is possible to have a negative beta, right? So beta could actually go less than 0. It's weird. It would be something like that goes against the market normally, like gold, that, you know, things like that. So you can end up with that as well.
that clarified it a lot.
Yeah. So yeah, I'm sorry we hadn't covered that already. That's kind of the downside of the MBA, right? Because I have some students that they did a business undergrad or whatever, and so they know all this, and then I have other people that are like, hey, I'm just a shift nurse trying to get promoted to charge nurse. I want to get my MBA, you know, and so trying to hit on both sides of that.
Up a little bit. I just wanted I wanted clarification from what I had read.
Right. And I'd mentioned the DuPont analysis, so we're going to have that piece in here as well, right? And I think I covered that a bit in that lecture, but all we're doing is we're taking that return on equity of the firm, and then we're just breaking that into a couple of different pieces. You know, the net profit margin, that is how good as the firm at turning $1 of sales revenue into net income. You know, how much profit do they get, you know, as a percentage of a dollar that comes in revenue? Okay. Asset turnover is how good is this firm at taking the assets of the firm and turning it into sales revenue, right? So if you think about a company that's got a lot of idle equipment, right? They got a lot of money tied up in machines that just sit there, their asset turnover is going to be low, right? Because there's a whole lot of assets. So like my dad was a coal miner, right? And that's a very, you know, it's an industrial process, right? It's a lot of big machines that cost a lot of money. And they would work, of course, right? I'm not saying they weren't using these machines, but a lot of times these machines do sit idle, right? Because you got to move things and everything else. If you compare that to Meyer, the grocery chain, right? What are their assets, right? I mean, they've got shelving, right? They've got some stores, right? But they've got green beans that are just going, the cans are just zipping through, right? This is just inventory, right? So their asset turnover is going to be a lot higher. So that's why when we're talking about these things, we try to put firms together, right? So you're not trying to compare two very different firms, right?
And like an airline, I don't know.
Yeah, because I mean,
computer.
Yeah, like if you look here, the asset turnover for the airlines, these are 0.8. For computers, this is 1.1. Hospitality, this was 0.3. This was 2.4. This is going to be a good story to talk about with these hotels, right? I'll give you a hint. One of them franchises a lot, and the other one owns their own hotels, right? So that's why you're seeing, right? How much assets do I own versus it's an asset that a franchisee owns, right? And they're just paying me for the use of the name, right? But that's what you're seeing here, right? Those types of things, right? But normally in an industry, you expect these to be pretty close to each other. When it's not, it's going to be something we're going to talk about. And I can't remember exactly this case, but I'm pretty sure this is like a franchisee versus hotels being owned by the chain itself.
Is there kind of a common asset turnover number, like when you're comparing to, like, even take, so obviously the hospital.
Yeah, you really can't say. It's going to be by the industry. That's what I was saying. Like a mining firm is very different than a grocery store, right? So some companies, they just don't need a lot in assets. It's just a big sales force, right? And then other companies, we make stuff, you know. So we're going to have all these machines and all these assets that are here that we use to make whatever that product is.
Like the newspaper one that has a 0.6 and a 1, would that be considered fairly different, or is that still?
It's pretty different. But then also with that newspaper, you know, you see a couple of these, it's like no meaningful figure. And so what you can be also seeing is, because I don't remember what's going on with those newspapers, but as an industry, it's not doing very well. And so you might be seeing something where, you know, maybe one newspaper is like rented out their print shop or something, you know, they've got some other way of, or maybe they slimmed down a lot, you know, that kind of thing. So, but yeah, we'll go through this. Like I said, I'll put up the case itself, and then I'll put up these, the Excel spreadsheet. But this will
be valuable
of us playing with those numbers and kind of, you know, being able to compare these. So we'll do this one next week. And like I said, I'll put up a few more lecture type videos, you know, to go over this stuff too. But But yeah, I just find that people do a lot better when they can actually like go in and do it. So that's why I try to do it.
So I just wanted to ask you a very brief question. You don't have to get too in depth because it's very hypothetical, but I spent a lot of time working on this case and breaking it down because I have this fascination with Buffett, kind of always have. So let me ask you this, based on your expertise, this question came to mind and I didn't know how to answer it or how to even approach answering it. But let's say Warren Buffett was born in a very different time, more like my age. I'm in my mid 40s. How do you think the difference that he faced, like his business model was consistent and consistent growth, and he had very strong metrics that he followed, but now we live in a time where we have changing technology and now we have this crypto and all of that. How different do you think the outcome would have been? I know it's very hypothetical, but based on your expertise, how do you think that would have changed?
Well, so to bring it back more into like an area that I do research in, right, which is like decisions under risk and things like that. As a generational rule, his generation was big on savings because of the Great Depression, right? And so I actually wrote a paper on this called Precautionary Savings, and it has to do with why people will have debt and savings, because you would say, well, why don't you just pay off your debt, with the excess money? But at the same time, it's like when you're poor, you understand, well, maybe I won't do that, but I need $600 if the transmission dies on the way to work, kind of thing. So, and so I am certain that his investment strategy is because of his background, right? Like what he grew up with depression and World War and, those kinds of things. And I'm sure that's part of why he's such a cautious investor, because again, it's a generational thing. So, if you think about your lifetime, right, in the 1980s, you had the mergers and acquisitions mania, right? And then you had the financial crash in 1987 because they changed the tax code and you didn't get to write off all this real estate stuff that they were doing, and so you had that happen. 91 Gulf War, and then followed by a recession, right? You saw the federal government balance a budget in the late 90s, right? The contract with America, Newt Gingrich and all that. So you saw that happen, but then you saw the dot-com bubble crash right after. 9/11 happened. Then Bear Stearns and Lehman go bankrupt, right? I mean, like, yeah, I imagine, I don't, it's hard to say exactly how he would turn out, but I definitely understand why there's such maybe a gambling mentality with so many investors, just given how we've seen, as much as we've had consistency as a nation, we have had extreme highs and lows regionally. And I'm not saying like this one region's been hit. At different times, different ones would spike, but what's been so different is things have been smoothed over so much, right? This is kind of like that, I guess, that divide between the financial economy and the real economy, right? Where, you can look at stock market growth and all those things and, hey, everything's going fine, and it's like, okay, but most Americans don't own stock, right? So they're not benefiting from that, right? And that kind of thing. So, yeah, I don't know. Although I hold out hope that this is building a generation of really good investors. Just kind of what we're going through. I don't know if you've ever heard of like the turning. This is like this theory that there's like 4 generations, and then we kind of go through this cycle, and I can't remember. There was a book on it. I think it's called like Google, like the turning or 4 generations or something like that. But it's like this group is like the explorers and these groups are the entrepreneurs. And, it's kind of like, if you think about, well, the greatest generation was like this, the baby boomers are like this, Gen X is like this, Gen Y is like this, and that kind of thing. So I don't know how true any of that is, but a lot of people do, they look at these cycles that we go through, right? And if you think of 4 generations, this is about 80 years. And they say about every years we go through this kind of weirdness, right? So if you go back to the 1770s, we did it and we ended up a new country. 80 years later is 1850. The panics of 1850 led to the Civil War, right? 80 years after that, we're in the Great Depression, right? And that leads into World War II, So I'm not saying we're going to go to another depression, but it's just like every 80 years, we kind of go through this correction cycle, right? And really the 80-year cycle isn't so much, I'm not trying to say it's like these depressions and stuff. It's really more like the country really changes. Like we went from colonies to being our own country, but we were a country that was like a collection of states. And then we had the Civil War. And then it was like, no, we are definitely a union. Like we clarified, all of that. And then if you look at the next cycle, well, World War II is when we went from being this isolationist, hey, we're just going to focus on North America. We'll have the Philippines, we'll be in the Caribbean, but, we're going to stay out of stuff. And then after World War II, it was like, no, we're the world's police now, and so we're probably going to go into a new phase, a new America.
So the reason I bring that up is whenever I first graduated high school, someone wanted me to invest in Berkshire Hathaway. And at that time, the stock was around 19,000 or ish. Which seems like a great deal now, but that's a lot of money for me back then.
Oh, sure.
So I had that question in my mind, and then I cross-referenced the stock value of Berkshire Hathaway along the way, and it's actually tripled in value since 2008. So obviously they've already accumulated enough capital and are using that to make money, but it seems like they've been able to overcome the ever-evolving technology to continue to build that wealth. So I don't know, I'm pretty fascinated with it. So I appreciate your time and giving me your opinions.
Yeah, with this particular case, like it seems like this was not the best deal. But, if we hadn't had COVID and maybe there would have been some big explosion with rapid prototyping and 3D printing and all of this, and suddenly it would have taken off. But as you pointed out, I mean, he's got so much, right? So Geico's making plenty of money with the little gecko running around selling you insurance, right? So that makes up for a lot of missteps too, right? So, but yeah, actually, if you find that kind of stuff interesting too about those cycles, because the economic cycle, I think they say it's like every 30 years. So we're kind of due for one of those. And what's kind of weird is if we have an 80-year cycle and a 30-year cycle, then if you take the beginning of the United States and go 240 years, that's, 2030, kind of thing. So, that's, we're seeing two changes occur at the same time. So there's a book called The Storm Before the Calm that talks about that. So the guy that wrote it basically is saying he's a Hungarian Jew, survived World War II, and then his father worked for the OSS, which became CIA during the Cold War, because he went back to Hungary and was doing this stuff. So he's kind of seen like humanity, I guess, at its most base, kind of thing. So the book, the reason it's The Storm Before the Calm is he's like, well, America's going to be okay, because if you think about it in terms of like civilization, America's on easy mode. We're the largest gas exporter. We're currently producing more oil than Saudi Arabia. We're pretty good from energy standpoint. We got a lot of land. We produce about 3 times as much food as we eat. We produce so much food, we turn enough food to feed Africa into gasoline, So, we're on easy mode, right? Compared to someone in Bangladesh, and I'm not trying to slam on Bangladesh. I live there. I mean, but it's just different. There's hard mode and there's easy mode, and so, so his premise is basically, this is the storm before the calm. So it'll be nice, but we're going to go through some rough times. Not saying we're going to have the Civil War, we're going to have the revolution. I don't, people get scared when you say stuff like that, right? Because some people, do say, I'm not saying anything like that's going to happen, but it may be some rough times, but eventually when we come out on the other side, we're probably going to be better for it. And so whenever I think of the hard times of like kids trying to go through high school and COVID and all this kind of stuff, I'm like, but you never know what that's going to drive them to do in the future, right? So I'm always amazed by what some American will come up with, So I think it'll work out, but I know it's going to be probably a little rough here for a little bit. So I don't know how he would have been. He might have been one of those slick-haired guys on Wall Street doing the buy mergers and acquisitions with I used to have those shirts, the powder blue with the French cuffs and French collars, and back when I was a broker, and that kind of thing. So, even the monograms, right, on the cuffs, right? But he might have been one of those guys, selling stuff out there. I don't know, but it's funny too, because you could also imagine what if he were back in the 1920s, right, with J.P. Morgan and all those guys. What would he built some huge empire, right? With the robber barons and all that kind of thing. So it is really interesting. But yeah, I think in his case, it's really more like that generational thing where so many of those people with what they sort of experienced, right, when they came out on the other side, these are the people that, would wash out the Ziploc bags, right? So they could reuse them, right? This is just a different mentality of, let's make use of everything that we have, right? And you experienced the 80s. That was not the mantra then, right? So yeah, it's an interesting hypothetical though. Yeah. So.
Well, we live in this culture now where, especially when you talk about stocks, people are just trying to strike it rich all at once. They're throwing their money at this crypto and hoping it blows up like Bitcoin and blah, 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 blah. And I don't know, you got to be a little more patient than that. You will get older eventually. You just can't convince them that they're going to, but they're going to.
Right,
so,
right.
I'm going to go ahead and sign off. I appreciate
right.
your feedback and thank you for your service. And
yes,
I'll
sir.
see you all soon. Thanks.
All right. You take care. Take care. Is there anything else, Vivian?
Not right now. No, thank you. That was very helpful.
Okay. All right. Well, I'm gonna end this and then I'll put the video up. It's not up to me. It's up to YouTube when it hits. But I'll wait till it hits before I tell you guys so that you're not pulling your hair out like I seem to when it says it's there and it's not really there yet and all that stuff. So I don't know how those big YouTubers do it. I can barely do it with my little videos that barely get views. So I don't know how those people that do the 5 videos a day and they got sponsors and all that stuff,
You have to earn. I was talking to somebody about it. I had a friend that was trying to kind of build up a following, and you do have to. You have to battle with what you're battling with to get a certain number of views. And then I think your videos do get posted sooner and then you can get ads on them. It's
right.
Long stepping stone process. But
all right. Well, I will let you go and I will see you next week. But you can always email me too anytime you have a question. So